Good afternoon, everybody. It is Wednesday, December 15th. Big news today is the Fed. So the Fed had a meeting today. They came out and gave some guidance for what they're looking at moving into 2022 and beyond. And I think this is actually really good news. Since the start of the pandemic in January, February of 2020, the Fed's balance sheet has ballooned from about $4 trillion in assets to over $8 trillion. Now, what that means is when the Fed buys assets, the Federal Reserve buys assets with money that never existed. So they're juicing money into the economic system. And one of the things we've talked about in the last couple messages is that there's just been this wall of money that's been coming at the financial markets right now. In the short term, probably helped ease the impacts of the pandemic. In the long term, you are getting what we are seeing right now, which we have producer price index up north of 9%. Consumer price index now, a couple prints recently, well over 5, even 6%. By some measures, depending on how you want to measure this, some people are even saying consumer price inflation is over 10%. But none of that is a good thing in the long term for the economy. So what we really wanted to see from the Fed is that they would not let these kind of inflationary numbers get out of hand. And so what I'm seeing from them come today is really, really good news. They're saying we're probably going to get about 3 rate hikes in 2022, which essentially will take you from 0 to about 3/4 of a point, maybe to a point. Keep in mind, these are still unbelievably historically low rates of interest, even with these rate hikes. But again, 3 rate hikes, I think it's a good thing. I think it also is the Federal Reserve saying, hey, there's inflation in the economy. We want to try to get ahead of it, squeeze it out. And it's also saying the economy is rebounding to the point where we can do this stuff. They're saying another couple rate hikes into 2023, maybe even one into 2024. Perhaps more significantly is they're going to back off on the asset purchases that they've been doing. Starting in the beginning of the pandemic, the Fed went out and was just buying $120 billion worth of assets pretty much every single month. That's $1.5 trillion of new money getting blown into the system by the Federal Reserve since the pandemic started. They recently dropped that back to about $60 billion in asset purchases. Now they're saying the goal for this year is that completely goes away, and then maybe even down the road they can start to reduce the size of their balance sheet again. All of these things are really, really, I believe, good points that are going to help keep this inflation in check, hopefully nip it in the bud. And at least the initial response from the equity markets, you normally hear the Fed lowers rates, equities like that, the stock market goes up. Actually, the market's initial response, we'll see what it does in a couple of days, but was to really rally on that news that the Fed was going to become a lot more hawkish. And I think it just reflects the fact that companies don't want to live in these hugely inflationary environments. And when you have money pushed into the system, in the short term it helps. It stays in the system for too long, it causes some imbalances. It becomes very hard for companies to make plans for the future if they don't know what cost of supplies are going to be, what inflation rates are going to look like. So I think today's news from the Fed, really, really good news. The other thing I think we're seeing, which is really positive, labor force participation is going up. I think you're really going to see in Q1 where a lot of the people that have been out of the labor force, they've been burning through savings, they're probably going to re-enter the labor force now because they're going to need to. I mean, our savings rates were up around 20% at the peak of the pandemic. Now they're down to about 7 or 8%, which generally speaking is a good thing. It's a more normal number. But what it's going to do is it's going to force people now to get back out into the labor force, which hopefully will ease some of these issues that we're hearing from people around the country that they're having a hard time finding employees. So quick message today, only about 3.5 minutes, but so far anyway, what I'm seeing from the Fed, it tells me they're trying to get ahead of this. The initial response from the markets was kind of positive as well. None of this, I think, is a surprise. The Fed has telegraphed that they are going to be looking to both stop these asset purchases that they're doing, also begin to tick up interest rates. All this stuff is good. I think it says we're going to hopefully get control, get ahead of these inflationary pressures we've been experiencing, and then also that the Fed is looking in their crystal ball, if you will, for whatever that might be worth, but they're looking into what they're seeing, the data they're seeing, and they're saying, hey, this economy actually is pretty darn good. It's going to be fine. We don't need these extraordinary measures that we've been doing for the last 2 years now that have just blown everything out of proportion in terms of the amount of cash in the system. So we might have more to say on this over the next couple of weeks. Short one at about 4.5 minutes, but I definitely wanted to address the Fed coming out with that big news today. So I think it's all good stuff. If you have any questions about this, please let me know. I look forward to talking to you. Thanks for tuning in. See ya.